Okay, we'll start. So I was talking about market structure shifts. In the silver bullet, the main part is validating that your market structure shift is correct. Because you're looking at this and you want to find a reversal. Because don't forget, a silver bullet is a reversal pattern. All you're doing is trading the reversal. So in every single reversal, there's going to be one of two things. There's either going to be a mitigation block or there's going to be a breaker block. The best market structure shifts, and you need to make note of this, is going to be inside of, or it's going to be the breaker block. So in this case, our market structure shift there is a breaker block. So even though it didn't displace through it, which is what you normally want, you want it to trade through it like that and then go into a fair value gap above or below the market structure shift and then trade through. Even though it didn't do that, it wicked through and then it went into that CB. It's still fine to use as a market structure shift because of the stuff we went through in lecture 9, I think it was lecture 9, where we talked about what happens when you wick through. And then on top of that, we're looking at the idea that this is a breaker block. So why is this a breaker block? We have a high, we have a low, then we have a higher high, and then we have a lower low. So our market structure shift is a breaker block. This is the breaker block. So when we're looking at a breaker is a type of order block. What do we know about order blocks? The opening price, or the most reactive part, is going to be the low and the high. So when you're framing silver bullet trades and you're looking for that reversal pattern, you're looking for either a breaker or a mitigation block. The breaker is going to serve you best. A breaker is just stronger than a mitigation. That's just how it is. A mitigation block is a better draw on liquidity, but a breaker is a better PD array to use for support and resistance. So we have a high. We have a high, we create a low, which is using this order block as support. Why is that stronger? Because it's not lethargic price action, there's a real displacement occurring here. So we put in that high, we displace lower, displace higher, a little bit of consolidation, getting more traders in on both sides of the marketplace. So now there's traders up in there who have their buy stops at that level, and there's also traders who have their sell stops at this level. That's why we accumulate it, to generate liquidity on both sides of the market. Then we break above that, taking out these buy stops. That's your liquidity sweep, and it's also your first part of the breaker. Then once we trade back below it, that validates this breaker block, making this, yes, a liquidity sweep initially, but then it becomes a run. And why would we expect it to act as a run? Well, it trades below, it's a breaker. We have the bearish narrative of going into our new day opening gap, which we talked about earlier on stream, using these relatively equal lows between Asia and London as a target. So you Judah swing above midnight open. That's your discount and premium tool that you use to gauge the daily range, and it's particularly effective in London. In the New York Open, it will serve you well, but in London, this is your best friend, the midnight opening price. That's how you're going to determine premium and discount. You're not buying above midnight opening price in London. You're not selling below midnight opening price. A fixed rule for you during the London Silver Bullet is you can only sell above midnight and you can only buy below it. Relative to the daily range, when we accumulate and then we Judah swing above that, this is your sign that you're now in a premium. You traded above the Asia high, you've gone above midnight opening price, you've put in another high, traded above it, broken down below. That's your bearish breaker block. Framing it through the lens of a silver bullet, market structure shift, this blue line, I'll make it bigger if I can. I think that's big enough. SIBI there, bearish order block there, bearish breaker entry there, fair value gap entry there, fair value gap entry there. There are so many ways of getting into this trade. The most important thing though, and the thing you really need to hone in on, and the thing you really need to do homework and back testing and data collection on, is the market structure shift. focus on identifying the breaker block and the mitigation block. The breaker is going to serve you better. The mitigation block is better, is good, but the breaker is better. In every silver bullet, you're going to have a breaker or a mitigation block. You want the breaker if it's a sweep below. Obviously, later on we run through, but in that current moment in time, when you wick below, that is still a valid market structure shift, but it isn't as strong as displacing below. So what can we use to establish more trust in the idea that it's going to trade back lower into the new day opening gap? Well, we can use the idea that this is a breaker block now. We've accumulated after displacing higher, generating stops on both sides of the market. We trade above this high, balance price range there, failure swing, more accumulation, that puts stops where? Here, here, and in the new day opening gap. That breaker block acts as resistance, that's your sell entry, or that's your sell entry. If you weren't here for the live stream earlier on YouTube, oh, I'm probably logged out. Well, I showed execution on the live stream, you can go check that. Okay, that's what I wanted to say about breakers, market structure shifts. Does anyone have any burning questions about that? Yeah, you do use inverted fair value gaps. It looks like 2022, that's because it is the 2022. A silver bullet is a 2022 model, but it's time-based. You're looking at it through a specific time window where you're on the 1 minute chart, the 5 minute, the 15 minute chart, and you can really easily find your setups without having to be at the charts all day, without having to constantly look back and forth. It is easy, I'm not gonna lie. If you can get the hang of the reversal pattern, and I've already given you a lot of gems here, and I'm recording this, so if you haven't got it all, don't worry, I'm going to post it on YouTube. You know, the reversal pattern is the most important part of the bullet. Your target, your draw on liquidity, your stop placement. In a minute. So entered there, for example. My computer's still very laggy, I don't know why. Where's your stop loss? Initially you could have it there, and then take profit at the new opening gap. Return? No. That is one of the most dangerous things you can do. As I showed earlier in the stream, how prematurely you can get stopped out by doing that. You're not adjusting that until your point where it could reverse on you now. Like I can trailing it. Even the idea of setting it to break even, in my opinion, is a flawed strategy, because whatever your entry is, it doesn't matter. The algorithm doesn't care about your entry, it cares about price action and time. Is this a valid place to have your stop loss? Yeah, because it's above the breaker block, we've already displaced lower. You know, from there, if it trades back above the breaker block, you're just wrong, and you made a mistake, and you pay for it. Putting it to break even, can it trade from this level back into that breaker block? It could. It could wick it and then quickly just wick and trade back down. So that wouldn't be where you would want your stop. Then for your take profit, you're looking at, in London, you really want to use the new day opening gap. Why? Because it was only formed like 6 o'clock, so that's 10 hours ago. In London, it would have formed 10 hours ago, and you really want to be using the new day opening gap, provided that you're near to it as a reference point. Midnight opening price is your best friend, but you're not taking profit at midnight. This is your discount and premium tool. You're not looking at this for a take profit. You can use Asia's relatively equal lows, Asia's inefficiencies, Asia's high or low. You can use the highs or lows or the consolidation formed between the Asia and London session. You can use previous New York PM liquidity, but usually that one's not going to get taken. You're not looking at previous day highs or lows. How often does the London session go out and take your previous day high or low? Way less often than the New York AM does. So in the New York AM, that is a more relevant liquidity pool. But in the New York AM, sorry, not the New York AM, in the London session, it's way less relevant. You really want to be focusing on the Asia's low, Asia's high, and then these 2 hours between London and Asia. Usually it'll consolidate, and you want to look at those consolidation highs and lows. Okay, does everyone understand that? What deems London as high probability? Like, how do you recognize if London will not get sloppy? That's a really good question. If Asia's range is really big, what deems really big? Well, I can't just give you a fixed handle amount because, you know, in a year from now, if I say 20 handles today, when the Nasdaq's trading at 27,000, 20 handles of right now volatility versus 2 years from now, 20 handles is going to be a different value in terms of relatively to the average range. So I can't give you a fixed handle amount because that will never be a long-term thing. But you want to look at it relative to the rest of the range, to the rest of the day, to the new day opening gap size. You ideally want a new day opening gap that's a few handles at least. Something that's one handle, you would use the regular trading hour gap. But as a rule of thumb, you don't want the Asia to be larger than New York PM from yesterday. Generally. When you have a small Asian range, you're more likely to trade above that, use it as manipulation, and then trade below that. Generally, you want to focus on one side. You don't want to pick both sides because then you're leaving nothing for the New York AM. And New York AM is typically going to refer to either the London low or the Asia low or the London high or the Asia high. You're not expecting London or you're not counting on London to take both sides of the range. Now, there's going to be some days it does do that, but you really just want to focus on one. So after you've taken the Asia high and you're looking for that purge and reverse setup, are you looking for it to revert into the Asia lows? Something in between, like these relative weaker lows, this inefficiency, this new day opening gap, or you can use fulcrums. I've taught fulcrums on my YouTube channel before. Fulcrums are very powerful when combined with breaker blocks. So you could use from there to there. And generally we use one standard deviation away from that fulcrum, so it'll be here. With fulcrums, you're not trying to pick out the lowest low or the highest high, you're just trying to get the lion's share of the move. Now, I'll go past one standard deviation and I'll use 2.5, and sometimes I'll use 3, but generally 2 is going to give you the lion's share of the move. What else could you have used as your fulcrum? You could have used this, because that's a retracement relative to your underlying narrative and bias. So if I put on a 2.5, you're not expecting or demanding tick-to-tick precision out of these. You're just looking to capture or confluence with your narrative where price or how far price is going to go. In London session that works very well. In New York AM session that works very well. Generally, you don't want to be doing it between, those ranges where you're in between kill zones, except for the pre-market hours. I find it works really well if you have a large range pre-market range. So if you're in a 40 handle pre-market range, nah. But if you're in 100 handle pre-market range, fulcrums will serve you very well going into the AM and just trading through the pre-market range. I think I've gone through most of what I wanted to go through. Any questions on that? Does everyone understand? Just say yes if you do. If you don't, say no. Because if there's anything you need clarification on, I'll clarify it right now. Yes. Okay. Good. Good. This will be posted on YouTube, by the way. So if you missed something, then it's fine. London's more likely to touch yesterday's high or low? No. London's not very likely to touch yesterday's high or low unless you're looking at a classic buy or sell day profile. Those are the days where it can, you're not counting on it, you're not relying on it, but it can, I mean, every day it can, but those are the days where you're anticipating the possibility. Whereas generally, you're not really looking at the previous day high or low during a London session unless it's in very close proximity, or it's a Monday, Tuesday, and Wednesday, and you're looking at a classic buy or sell day. When I do the mentorship on classic buy or sell days, you'll understand that more. Until then, you can use the daily high or lows, you can draw them out and stuff, but don't count on them being reached during the London session. Gotcha. Good, good, good. Okay, we're going into our 9:30 open. Our pre-market low is also our data low. Our pre-market high is also our data high. Thinking if I should go or if I should stay for the rest of the session. I can't believe I thought today was CPI. Stay for the session. I'm hungry, man. I've only eaten a cake and a mocha today. Spit some gems for the session and then go. What do you think I've been doing for the last hour? People keep asking about private mentorships. Chill out, man. Like, it's free. Stop complaining. I'm giving you more in this for free than people will charge you for. So, yeah, you haven't got to ask me constantly about private mentorships. What if the data high is sweet? We wait for ATM, or do we have data low as target? ATM model. We're looking at silver bullet, man. How can we use mitigation blocks to draw liquidities? Excellent question. Oh, high, low, low. Okay, so if you were in my stream, I don't know if it was yesterday or the day before that, we were talking about buyer's remorse or seller's remorse. A mitigation block is where price is going to return into a mitigation block to let buyers or sellers out of their positions. So here we have a low, high, and a higher low. So with a breaker, it's a low, high, lower low. With a mitigation block, it's a low, high, higher low. The reason a breaker and a mitigation differ is because in a breaker, we stop these traders out. So anyone who's in buys here, they're stopped out. But here, everyone's in sells, right? Most people are in sells. It goes against them, so now their positions are underwater. So anyone who sold in this range where we displaced lower, this is important. Just using that 3-candle pattern where it's low, high, lower, low, and it's tiny, that's not enough. You need it to look like an institutional price leg, where it's clearly retail being engineered and put into the market on the wrong side. So institutions or retail or anyone who's not using a hard stop loss that's in this leg of price action, when their positions are underwater here, the algorithm's going to come back down into it and offer them a way out of their positions. Now, it doesn't always lead to break-even price points where it trades down in and fills the entire mitigation block. You usually want to use the high of it, like that, as your draw on liquidity, but expect it or allow it to get filled in entirely. The reason it's seller's remorse, or buyer's remorse, their positions are underwater, they're in loss, it trades back below it, offering them a way out with much less drawdown than initially planned. So they're settling for the idea that they can get out now at break even, or way less loss than they were normally in. So anyone who got caught offside in sells, the algo's going to want to come back down into it and offer them a way out. So here it releases the short selling pressure. We could expect a reversal. What? I don't know what you mean. No, I mean, this is going to give you time distortion going into the opening price, sorry, the market open. I wouldn't be looking at this and trying to force a trade. I would wait for the macro. I would wait to see what the open presents. Is it going to take the data high and trade back into the data low? Is it going to take the data low and trade back into the data high? We've already taken the August 14th high, so it doesn't need to trade back up into there to sell off. But we do have that major buy side liquidity on the daily chart, which is all-time high. So if you just look at your charts and you go to all-time high, it's that one, which we could trade into. You don't really want to be selling around data highs, or sorry, around all-time highs. If it was me and I was looking for a trade, I would want some form of manipulation into an area of support before trading at all-time highs. So manipulating this low, that low going into this fair value gap, that's fine. Low, high, high. But we haven't traded back below. Yeah, I want more information out of this because it stopped out both sides of the chart or both sides of the marketplace. You really need more information than this little accumulation and that little V shape. You need a lot more. Head and shoulders is also a mitigation block then, right? Trapping positions at the head. Yeah, but it's about the narrative and the filtering of the mitigation block. So a mitigation is inside of a head and shoulders pattern, so it's a breaker block. Every single form of reversal is going to have a mitigation block or a reversal, or a breaker block. The reason we use mitigation blocks rather than a head and shoulders pattern is so we can filter it more. Okay, that's exactly what you want. If I was looking for buys into all-time highs, I would want it trading below the data low and below midnight opening price, because that would be a deep discount. Potentially into the new day opening gap. I wouldn't demand it hits the new day opening gap. But if I was looking for a buy setup, one potential scenario is it trades down below here into the end dog and then back towards the all-time high being up there. That makes sense. Yeah, so first presented fair value gap would be the 930 candle. It hasn't finished forming yet, but yeah. Okay, that's good. So that's your first presented fair value gap. You want to use quadrants on that. From this candle's high to that candle's low. You're putting quadrants on it like this. Because it's a larger range. Okay, but that is going to